as we pivot to Asia, we want to provide an update on what's happening between China and India. So right now, there was some high-level meetings between the military to come up with, there was some recent events that we covered last week and the week before, and that created a much bigger setup in terms of where do they kind of shake out heading into winter. And those negotiations broke down. So there's a lot of friction and tension right now on the Indian-Chinese border. It'll continue. It's been terse, but it hasn't been as bad. And now we're getting to, again, not levels that we saw in Ladakh when there was actual deaths, but getting to a point where you're starting to see some of this tit for tat again, which will be a much... You'll see it slow down as, obviously the winter thaw happens, and during the cold months, these negotiations will continue. But China continues to harden assets, and then India is doing the same thing. That they're trying to meet a lot of this essentially play by play, so that they're not caught off guard, and you can see some of these different setups. Now, another piece that we continue to see. China is hardening or expanding bases that would be pivotal for a Taiwanese invasion. Now, it's not something that would happen outright. There would be a huge loss of life given how heavily fortified Taiwan is, and obviously you'd have to use an air, amphibious, and paratrooper attack to do it, because Taiwan also has assets that China needs and wants. So it wouldn't be like, let's just carpet bomb and show up. This would have to be very tactical, again, with Taiwan being well prepared and obviously well fortified. So, but you are seeing a different way of saber rattling. So there's only so many sorties you can run, but you can also start to harden assets and expand capacity in these areas that can also be a show of force. So these are some of those things that are happening now as India and China cool off into the winter months, not because they came to an agreement, but because it's near impossible to move. You're going to see more South China Sea increase saber rattling, not less. And this is going to be a very big flashpoint as we continue through, especially the winter months, as some of that movement is shifted away. So now, just providing that geopolitical update, we wanted to shift a bit into Japan and now look at where things are shaking out. So when you look at machine tool orders, they slow down versus the prior, but still strong. You're still seeing lending. PPI, though, is the one where we're seeing a fairly big increase in PPI in Japan as well. So the expectation was for 5.8, came in at 6.3. So again, you're seeing this elevated move, which is weighing on what are those export prices going to look like? Because again, one of their largest trade partners is the U.S. So we are going to import this increase in price. Now, container rates have come down, shipping rates have come down, but this just means that the stuff on them is going to be more expensive. Now, when you look at core machine orders, they fell, but year over year they're still up. As money stocks actually came down a bit, as we continue to see some liquidity getting pulled out of these countries. Again, not a taper, but just a little bit of a tightening because there's so much excess liquidity that remains in the market. So then when we look at India had some decent numbers overall, with CPI coming in below estimates of, the estimate was at 4.5%, came in at 4.35%, and industrial production was expected at 11.6, came in 11.9. Industrial production, because that was for August, will go up again in September, but in CPI is also going to go up. So we were expecting this kind of this slowdown and now a bounce, because you had a mark to market on natural gas, on gasoline, and not even a full mark to market, but a partial mark to market on these that is going to pull CPI up as we go into October. On the other side, they've already started to ask essentially edible oils to cut pricing, because vegetable oils, a lot of these essential products are just exploding in price. And that is another bigger headwind that is coming into the food side. They've already reduced tariffs and fees. So now they're asking some producers and importers to pass on those cost savings to try to mitigate against some of those food pricing increases that we're starting to see. On the South Korea side, you can see that unemployment is fairly stable. Money supply, again, fairly stable with a little bit of an increase on M2. This is where we're seeing a bigger issue in general. Import price index went up in a sizable way, because it went from a revised 1.3% to up 2.4%. Import price index year over year up 26.8%. Export price index was at 18.6% year over year last month. Now it's at 20.2%, and then the export price index remained at up 1%. It went up another 1%. So again, you're seeing these pressure points, not only just in Japan, not just in India, not just in China, also South Korea. Again, we are importing that because the stuff on the boat is costing more. And as their import prices go up, that's going to push their export prices up as well, which is going to just be us importing more, price increasing, and inflation. So then when we look at China, so I remember China's, they saw 515 million tourist trips in National Day holiday, October 1st through 7th, down 1.5% year over year, and recovering to 70.1% of pre-pandemic levels, so still down 30% from pre-pandemic. Domestic tourism revenue in the holiday fell 4.7% year over year to 389.1 billion yuan, about 59.9% of pre-pandemic level, or really 40% below normal. China's two largest coal production hubs has asked the coal areas to increase production. Authorities in North China's Inner Mongolia Autonomous Region has told 72 miners to step up annual capacity output. So again, these are ways to try to mitigate. But then when you look at the Caxton, as we talked about, that went up. We expect that to come back down, not into contraction, but into just much closer to 50. Exports were up, and we always look at the CNY, or just to keep it consistent. So export expectations were 13.3, but actual was 19.9%. Very good. Imports, though, was expected at 14.6%. Actual came in at 10.1%. That is a big overhang, because look at the prior. The prior was up 23.1% versus exports. Imports should be above exports, because you're importing goods, assembling it to export product. And the fact that, and we've talked about this the last 3 weeks, the new export orders are coming down, new import orders are going down. So this is very consistent with what we're seeing, and it points to additional slowdowns on trade coming out of China. Now, when you look at the aggregate financing, expectations were for 3 trillion, 3.05 trillion, came in at 2.9 trillion. New yuan loans were expected at 1.8 trillion, came in at 1.6. Again, you're seeing this continuous drain of capital. And as we've been talking on Twitter, they've been taking about anywhere from 190 billion to 90 billion yuan out of the system, because remember, they increased liquidity ahead of Golden Week and ahead of quarter and month end, and now they're taking it right back out, which is what we're seeing in the money supply decline across M1 and then M2 staying fairly flat. Now, CPI was down, expected a 0.8% increase, came in at 0.7, but PPI went up. Was expected at 10.5%, came in at 10.7%. Again, they're trying to export as much of that as possible and force the companies to eat that price to protect the consumer that is already struggling. So then when we look at that China PPI, this is the highest it's been since the 90s. Again, a lot of this pressure continues to mount on their economy and what that means for the export side. And then the China aggregate financing cumulative, still well below 2020 ratios, which is where they want to be in taking out some of this liquidity. So then when you look at China's stimulus and business cycle, credit impulses are starting to bottom a bit. And that's what we've been talking about, was that they don't want credit impulses to go down anymore, but they're trying to manage it here. Then what are they doing? They're taking out money through reverse repos because they're going to cut the triple R rate. And when they cut the triple R rate, they need to make sure that that's offset. And they're going to cut it for the micro, small, mid-cap banks to try to support some of those struggling middle SMID-cap businesses. So PMI will bottom a few months later. So again, you're still seeing a lot of this movement coming down as PMIs continue to remain under pressure. And where is a lot of this being caused? Well, let's look at what's happening in the high yield index. So Chinese developer Sinac warns of default on 250 $250 million bond due next week. Sinac Holdings has $694 million in dollar bonds outstanding and has already missed domestic payments last month. Borrowing costs for dollar junk rated debt, which is dominated by Chinese developers, soars to the highest level in about a decade with a yield of 17.5%. As China enters the final stage of one of the largest real estate booms in history, it confronts a staggering bill of over $5 trillion in debt that developers took on when times were good, nearly double what it was end of 2016 and more than the entire economic output of Japan. So just to give you an idea, where everyone thinks it's so small, but it's over $5 trillion US dollars. This is a $5 trillion US dollar number, and it's getting worse because, shocker, they're finding out there's a lot of hidden debt that wasn't on the balance sheet. So it is much worse. This contagion, this is underlying contagion. China developers in October. So in October, you had Fantasia, October fault default. 2 directors resign for Evergrande. October 11th, coupon not received. Jinyan will pay just 5% of October 15th's note. Sinac won't pay principal interest due October 18th. Modern Land asks for 3-month extension. And here are yields. So again, Evergrande wasn't Lehman, but it was the start of Bear or Evergrande or Countrywide. You're seeing this accelerate, which is creating the underlying problem of back to 1990s. China's factory inflation is forecast to climb to the highest level since 1995, which is going to put more pressure. So you have the consumer, which is terrible. You have the slowdown on the real estate side, which was the growth engine for economic expansion, and now you have factory inflation again hitting these levels, just weighing down total economic growth, which still remains elevated estimates still remain elevated based on this underlying backdrop. Energy shortages have also spread. Share of output affected by energy shortages. This is just showing so September GDP and industrial production. In September, it impacted about 30 to 40%. In October, it's going to impact between 75 and 80%. Again, all of this is resulting in just more pressure on economic growth, more tightness, and you're already seeing inflation going up. And now the NDRC allowed electricity prices to go with coal, putting even more pressure on it. So then you look, India faces power outages as coal stocks dwindle, again, putting even more pressure where we had already talked about India. India has been trying to get out of their funk with this kind of stagnation that they've seen, and this isn't going to help. So it's not just the China that's going to see their economy impacted by it. It's also going to be India, which is facing up to 100 million people losing power on a rolling basis, which, as we've seen in Lebanon, with a total grid failure, people are now trying to sell their bank accounts for 15% on the dollar, 15 cents on the dollar, just because they're in such dire straits. So then when we turn forward, energy intensity sectors, steel have been hit hard amid power curbs. So here you can see rebar steel production weekly. You're seeing steel continue to come down as they try to mitigate some of those levels of just underlying electricity consumption. But there's also a significant amount of raw materials now sitting in storage, and you saw a lot of things go limit down the beginning of this week after the Chinese government announced storage levels. So then when you look at construction and infrastructure have slowed, this just gives you an idea of how much they've slowed and how they're fully in contracting levels on building floor space. And then the infrastructure investment has continued to contract. So again, just more things that are just weighing on general growth. So then when you look at reasons behind China's coal shortage, well, electricity consumption has continued to go up as coal production has flatlined. And then when you look at it, Chinese coal imports from Australia has gone through a floor. Again, creating the problem that they're currently in. And this is where we continue to see that there's not going to be a quick answer. And how quickly can they close that gap? And the focus is bringing in more Australian crude, increasing local coal production. Australian coal, increased local coal production, and decrease electricity consumption. So China's property woes have led to tens of billions in bonds trading at distressed prices. So you have all of this now coming full circle back to where do we sit on this whole component? So in a world where central bank stimulus has wiped out most of the stress, the distress from global bond markets, the troubles of China's property companies are standing out. Of the 139 billion of US dollar denominated bonds trading at distressed prices, 46% were issued by companies in China's real estate sector, according to data from Bloomberg, which captured bonds trading at yield premiums of at least 10 percentage points above their benchmark rates. So 64 billion bonds of Chinese bonds of Chinese property companies, 74 billion are other distress. So again, it's not even just real estate. There's a lot of other pressure points that we've talked about. Construction is falling, in local investment is falling, consumer is weakening. A lot of these things again continue to weigh on this future. But borrowing jumped in every subsector save residential construction. But where? And this is from China Beige Book. So here's the critical point from China's Beige Book's property sector report. Amidst this wreckage, property firms have scrambled for fundraising, but over the last half year, borrowing has surged primarily outside the formal banking system at shadow lenders. Remember, since 2014, they've been trying to cut back on shadow lending, and now they've essentially given up or at least relaxed those views so that some of these guys can get access to capital to try to save off a much broader decline. But again, this is still something that is a problem because how much is being counted, how much is off balance sheet, and this becomes a much bigger issue that can continue over just a short period of time. Now, China's Beige Book continues. China's credit growth, hit the slowest since 2017 in September amid slowing housing market and sluggish credit demand from corporate sector. So then when you look at how is this backdrop, well, Bloomberg China High Yield Bond Index has exploded, but volatility is down. So at some point, I think the market is still discounting some of these underlying issues that are, again, it's just a matter of when. When do people care? And the market cares when the market cares. We learned that in 06, 07. We learned that in 2011. Every shock, whether it be a recession, a slowdown, the market cares when it cares. And this is a perfect example of it, as some of the companies may be more levered than the reported figures suggest. Shocker, I know, China lying. So this is the current assets, current liabilities, and then discount. So not only is their debt sitting off balance sheet, but you're going to be selling stuff at distressed prices, which are already a haircut of 20 to 30%. So you're getting an idea of how this is compounding, and there really isn't enough collateral to backstop where this debt is currently sitting. And many more developers have defaulted in 2021, with more to come as they continue to see this stress continue to move through the system, which is why China housing and global commodity prices typically move pretty close together, and housing starts have gone through a floor and they're actually contracting while non-fuel commodity index continues to move higher. And at some point, and again, it's not a perfect correlation. There are points where it can outpace and outlast. Like you see it in 2010, 2011, housing starts came down, non-fuel commodity index stayed elevated. It finally caught up. So again, it'll catch up. It's just a matter of when, and when does the market care, and when does that supply demand show up. So when you look in general, just kind of wrapping it all together, banks are shifting funding from real estate to manufacturing. So this is where you're starting to see some of this kind of make up for it, but you're not seeing a lot. And given the sheer size of these two industries, it really won't be enough. So almost half of China's 30 biggest developers were in breach of at least one of Beijing's recently introduced rules on property sector leverage, according to the Financial Times. In August last year, the Chinese government unveiled the 3 red lines, which aim to constrain property developers' debt according to 3 balance sheet metrics: the ratio of liabilities to assets, net debt to equity, and cash to short-term borrowings. All of them have been blown through, and that's why you're seeing some of this reweighting, all of these concerns on liquidity, because these banks are sitting there with loans and bonds that don't have enough assets to back them. And that's where you're starting to get into this bad debt concern. And that's where you have to watch what the PBOC is doing. And that's where we saw the first triple R cut, increased liquidity, and we should see something different, but more targeted on the micro, small, and medium cap banks, because those will help some of these industrial guys, especially the small and medium companies. So a lot to go through. We try to do it quickly. If you have any questions, you know where to find us in the comments section on Twitter. You can always find me at MarkFNY. So thanks again for watching. We hope you have a great rest of your day. And if you're watching this tomorrow or what is going to be Friday, we hope you have a great weekend, and we'll see you for the Primary Vision Frac Spread Count show. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.